All right, and sorry for the delay, people. This is Gavin McGuire, event trader, bringing in Brett Manning, chart trader, for the latest installment of the Sentiment and Flow Show. Brett, how are you doing today?
Doing pretty good, Gav. How you doing?
I'm doing all right. Apologies again to everyone for the delay, but looks like we are ready to go and rocking here. Um, Brett, I guess there's a couple things that we could discuss here. It's probably going to be a little bit of a shorter show today because really the big items for the week are going to be later on, and with the Fed. We of course got Chinese PMI numbers, the ISM data, and the jobs report out on Friday, of course. So, there hasn't been a ton that's changed since the last time Brett and I talked. We were talking about the bubbling sentiment that was leading us to a potential breakout, and we're certainly getting some early plays there. So, Brett, I guess this week, I think a couple of things that we can focus on is one, that Barron survey that was out. That's a biannual survey that they release, and then some of the sentiment data that's showing a little bit of bubbling optimism here that I think we need to discuss. How's that sound to you?
It sounds good, though I would take issue with your use of the word bubbling in each case, because I think that that implies the sense of, of verging on euphoria, as in a bubble, what the sentiment would be like. And I would say that we're at the opposite end of the spectrum on most of the larger time frame indicators, and maybe only neutral on most of the shorter time frame indicators, with the exception of the SPY liquidity premium, which we'll talk about.
Okay, so perhaps it's my use of bubbling and your interpretation of it that we're seeing. I'm looking at this as just kind of the first bubble for the frog in the pot.
Oh, I
Not
see. Right. Not as in there is a bubble, but
not
that the
as in there is a
frog
bubble,
being
but
right.
yes,
Right.
just
The people who are the frog and let me just explain for people who are new. Gavin and I have tossed around a metaphor for a while called boil the frog. And it's based on what is really an old wives' tale, but the idea that you can put a frog in room temperature water in a pot on a stove. Don't do this at home. It's horribly cruel, but it's a market metaphor. Then you turn the heat on underneath the water, and if it heats up slowly enough, the old wives' tale is that the frog won't notice one change from 1 degree to another until it's boiling, and then it dies, and rather than jumping out of the pot. And this is often something that we see in markets where you have a lot of people short or flat who need to be long, which is a similar dynamic. In other words, forced buying is possible, but it just moves up by degree until everybody realizes it when it's too late and has to scramble. So we're seeing a couple of the first bubbles in that water, which means a lot of people who've been betting against this market or who've been too complacently out of exposure at the risk of really having some difficult year-end performance numbers relative to their benchmarks will suddenly find themselves needing to chase the market in a frenzy.
right. And to be sure, there was no frogs hurt in the filming of this Sentiment and Flow show. But Brett, let's why don't we start off with the sentiment trader data, and then we could break into the barons because
Okay.
we got a little bit of ebb and flow going on in the sentiment data that we get from Jason Geppert's site, and then we could touch upon our new toy here with that Barron's biannual survey. But
You got
one
it.
of the things that I wanted to talk about was some of the sentiment data that we're seeing really kind of show a little bit of a risk on appetite coming in. But before we get into that, I think we could just kind of recap some of the data that would have us leaning on the optimistic side, and that's been around for the last few weeks, and that's the soft versus hard economic numbers that we see, and then the small trader puts. I mean, these are themes that we've been talking really about the last 3 weeks, I think, running on the show here now. Really no changes to that. So I was curious as to your thought because I was kind of surprised to see some of the soft versus hard data stay on here, as I think that we've seen a break in some of that sentiment myself as of late.
Yeah, I mean we're healing out of a deep trough of pessimism, which is remarkable given where asset prices are, and that's really one of the main consistent themes that we've discussed, where there's this seeming paradox where you have the market performing well, but you have a lot of different data points that indicate that there's a lot of skepticism or pessimism that has become so deeply rooted that it's really tough, even with improving asset prices, to kick that out of the picture. And I think that does translate right through supply chains, just as we talked about last week. So we consistently see some of the softer economic data points underperforming relative to the hard ones, and it's become embedded in the nature of this phase of the cycle, where you see the harder data points, the retail sales and the employment data, et cetera, that have consistently come through pretty well. But we keep seeing, things like PMIs, things like different supply chain levels, upstream supply chain confidence indicators, where one piece that I wrote recently in my chart book is that this has the possibility to unleash a kind of pent-up dynamic. And I don't know if you agree with that position, but if we see sentiment improve, we see some steps that are at least acceptable on the notion of, an improving narrative around the trade war, and we see stocks breaking out, and we see, other data points holding up well, that you've got a lot of people in upstream positions in supply chains and industrial and manufacturing spaces where they've been really cautious and they've been holding back, and that could actually lead to a kind of catch-up phase where they have to really scramble, and that actually could produce sort of a pop from that same point. I don't know if you agree with that theory.
I completely agree with it, and that's one of the reasons why when we've been talking here, Brett, I've been pretty quick to point out inventory levels, which that kind of leads to how fast they can clear this out, because there's a difference between a cyclical downturn, which we just saw in the semiconductor space, and I guess we could call it a self-inflicted downturn, Brett, maybe perhaps, where it's a little bit more geopolitical, and people are simple. It's not that the inventories are lower because people are holding back and sitting on their hands rather than firing ahead and then getting caught without that demand there to clear out the inventory. And it's a pretty it needs to be understood, the difference, and we're certainly in the latter, where people have kind of been aware of this and have been clearing out their inventory ahead of it. And now we're even getting the semiconductor names working through their inventory issues. It's a big difference of having foresight to an inventory issue rather than being caught blindsided on the inventory issue. And that plays into that sentiment that you're talking about.
Yeah, and I would kind of look at it as the difference between something that's exogenous and something that's endogenous, right? Something that's built into the way that people are structuring their decisions, and sort of the Turtle Beach metaphor that we've discussed, versus something that's from the outside that comes in and puts a wall on the highway.
Right. Exactly. So, that continues to work through, and we're seeing that potentially play out. We haven't really seen it in the conference call commentary. I would say that, Brett. People, for the most part, have been cautious, not in terms of the inventory, but in terms of ramping up capacity utilization at the moment. But
have you heard a lot of people scapegoating the trade war uncertainty to kind of keep expectations?
Oh yeah, I would say that's certainly been the top reason for weaker guidance. We're
opportunistic at that point.
Exactly. You might as well, just clear out the decks and stuff. But we're just hitting that better than feared quarter once again. I mean, not to beat a horse to death here. I know that's going on 3 quarters in a row of such commentary. But they've just done a good job at reining in their expectations here. Let me see if I could see from the last S&P earnings report. Last I saw, Brett, we were running at, back on the 1021 report, 83% of companies were beating Wall Street estimates on the top and bottom line. And I mean, that's just a remarkably high number. I mean, just on average, it runs 73%. Hold on, I could get us the numbers here. So,
and you're saying that that's more about PR than operations?
Correct. I mean, that's just getting the analysts out to lower their expectations here. So the S&P Global Market Intelligence earnings report from the week of October 28th. So 79% of the 197 companies in the S&P have reported earnings and have exceeded Wall Street estimates. 79%. On average, again, it runs about 73%. Collectively, the companies have reported a 4.3% EPS surprise for the third quarter, and almost 40% of the companies reported at least a 10% increase in earnings per share year over year. That's some pretty strong numbers there, especially when there's a concern about an earnings recession here. Analysts are less optimistic about companies that have yet to report, they were saying. So the expected blend year-over-year EPS growth rate for the S&P 500 remains negative 2.9%, led by, and I think this is key, a 40.3% drop in the energy sector. Yeah, the energy sector is kind of like that X-trans number, if you will, Brett,
Yeah,
right?
exactly
I
right.
mean, where there's just so if we see an earnings recession here, and the majority of it is due to energy, that's something that people will be a little bit more willing to give a pass on. And again,
Absolutely.
right now we're looking at a negative 2.9%. On average, there's a 3% beat on EPS, so that could kind of sneak us into the area of what you may call it of a small beat. Now, the other thing to keep in mind for this year-over-year S&P change, Brett, the best performing sector, what do you think it would be, just off the top of your head,
Best performing fundamentally right now?
on the EPS side of things?
I mean, I would find it interesting if it's financials, I
It's
guess.
financials, and
Yeah, that's
that's up
interesting.
5.1%. That's real interesting because why? They're cutting rates this year, right? And everybody was expecting that net interest margin to go down, the net interest
Yeah, sure.
income, the net interest revenue, and rightfully so. And it has weakened, but on a year-over-year basis,
Well, but
that
no, they're cutting the short end. They're cutting the short
they,
end.
they, well, they are cutting the short end, and that leads
The
to a
Fed does not
steepening
control the
curve.
long end of the curve.
Right. That's economic expectations.
Yeah.
Correct. But
So I mean, they're widening. The Fed moves to cut. It's just going to make banks more profitable unless we're past the point of no return in the cyclical downturn.
true. But we did see weaker net interest margins on a sequential basis this quarter on the majority of names, and same with net interest income. But again, on the year-over-year
Well,
number,
what's the
like
midpoint 10-year on the quarter? I mean, you're talking about before a lot of the impact of that, I would say, right? I mean, we've got midway through the past quarter that you're reporting on right now. Where was the 10-year? Was it 1.45?
yeah, I mean, I don't know what the average numbers are. I'm just going off the net interest margins being weaker than
Right.
net interest income. But their earnings per share, let's not forget, they have also been buying back a lot of shares.
Yeah.
So
Right.
I mean, you look at a Morgan Stanley or Bank of America, a lot of that boost is a little bit fundamentally balanced. But I do think you bring up a really important point here with the slope of that curve, meaning that we're seeing financials in general too, Brett, because financials are kind of leading the way on this latest run. Wouldn't you
Yeah, and
agree?
they should be.
And
They have an easier playing field now. We're seeing 3 month to 10-year is now no longer inverted. We're seeing that kind of process, repair itself to some extent based on what the Fed has done.
based on what the Fed has done, do you think any of it, though, and I think this is the important question, Brett, because you're talking about the steepening, is this all Fed with the short end of the curve, or any sort of movement that you're seeing at the long end of the curve with perhaps a little bit more upbeat economic sentiment?
Yeah, I mean it's all of it together, of course.
Yeah. So I do think with financials leading this run here and what we just ran through on the earnings, that is definitely key. But again, the S&P looking for a little bit weaker back end. A lot of that has to do with the fact that we got a lot of energy names coming through. So I guess when we're looking at this potential earnings recession, it is key to note that a lot of it, the biggest drop is coming in those energy names around weaker
Yeah.
oil prices too. All right, so sorry we got a little sidetracked there, but I think that was an important thing to comment, especially since we're in the middle of earnings season here. But Brett, so we talked about that sentiment trader with the items that are reason for optimism. Now some of the things where people perhaps are getting a little too optimistic and thus some pessimism. Now I do think it's important to note, Brett, on some of the list of things that you have on your favorites. Really the only one that was very bearish in terms of the optimism side was the mutual fund cash, which we have seen a lot,
It's a
which
big
we've seen the
lag though,
last
but
couple
yeah,
of times, and it's a big lag.
it's been there for 2 years where it is right now.
Right. Now, I know the one that you want to delve into is the SPY liquidity, and we'll touch upon that here in a second. There's a couple that I just kind of wanted to knock off ahead and get your thoughts
Sure.
on. The first number that I was looking at is the advisor and investor model, which has slipped into just slightly um, overly overly optimistic territory, which means that it's a little bit pessimism given a run. Any thoughts on that one?
A little bit, but yeah. I mean that model incorporates price action from the market. So the fact that we're breaking out to new all-time highs becomes a mechanical strike against the rally based on that model, which I'm not tremendously a fan of. Um, it's a complicated model. It's got a lot of different elements to it, but I think that where it is right now is not particularly concerning, and I think that the aspects of it that probably have it elevated are more along the lines of possibly some. We've got junk spreads narrowing. We've got SPY liquidity premium way down, which we'll talk about, and we have a market at all-time highs, and that's going to put a lot of strikes against that particular model, but not necessarily in a manner that speaks to some underlying tip toward aggressive leverage by speculators in the market. So I don't really look at it as a red flag.
Okay. Next up, we'll skip the bear market probability model because I just think the Barron's discussion will be more interesting when we're talking
Yes.
about that. VIX term structure, though, this is one that we have seen move up, and my assumption is, Brett, that probably a lot of that has to do as we slip towards this excessive optimism, some covering of puts that we've seen moving into the market. Just curious as to your thought on this VIX term structure read.
Yeah, I mean, well, and it is what it is. It is the statement that people are not in any way right now structuring their positions in anticipation of a crash, and that's really what this indicator shows. I think it's not necessarily that useful when it's in complacency territory because you can stay there for a long time, but when it's a better bottoming indicator than it is a topping indicator. In other words, when we see the market particularly volatile, if this spikes way up like it did in late December 2018, like it did in early February 2018, um, that kind of action, when you see people backwardating the VIX futures curve. That's what this is. This is the VIX forward curve in terms of VIX futures contracts. And when the pricing of the front month contract moves up above the pricing of the 3-month out contract, this indicator becomes what's called backwardated. It's very rare for there to be conditions in which the expected volatility over the very near term is greater than the expected volatility a little bit further out, simply because the world is less certain the further out in time you go. So this is chronically in a state of what's called contango, where the prices of further out contracts in the VIX futures are always going to be above the very near-term contracts, simply by that sort of philosophical idea. Uncertainty, obviously, is greater in the future than it is a week from now. But sometimes when people feel like there's a crash, or they're worried about a crash, or the market is really started to get very emotional on the downside, you see the front month contract on the VIX futures actually spike above the out months. And that's an indication of extreme panic and fear in a market, and it often signals a bottom and a buying opportunity. When it's where it is now, it's a little bit more complacently positioned. It's not really below the absolute threshold, but it can sit here for a while, and it doesn't necessarily mean that you should take it as a sign to short the market, but there isn't a tremendous amount of anticipation of a near-term crash. That's the best thing you can really read from that.
All right. And then the other item that we had slip in here was the NYSE high-low ratio. This tends to see a little bit more volatility too. Probably a little tougher read because you could get a higher ratio on this just from a lower performance either on either end of those ratios, I assume.
Yeah, and I mean the Yeah, exactly. So there's two inputs there, obviously, and it's the comparison of the two.
Yeah.
But I mean, we're seeing the S&P breakout, the Dow near breakout, the Nasdaq near breakout. So you're going to have a lot of new highs on
Well,
the major indices.
and I mean, I guess we can build off that one a little bit because one of the things that I found of interest was the S&P 500 broke out to its first all-time high in more than 50 sessions earlier this week. Yet fewer than 8% of the component stocks managed to hit a 52-week high. So it wasn't a large breadth on that, and that's why I'm thinking, Brett, it's probably just a real low number on the low end of the ratio.
Probably we've been in a trading range for 6 months.
Yeah, and so I guess that's why I was a little bit dismissive of that. Um,
And the other thing is, remember where 52-week lows are. Remember what we went through at the end of December.
yeah,
That was the pit of hell, right? And a lot of stocks were kind of crashing then, and that's still within that 52 weeks. It's going to be awfully tough for most stocks to be underneath the level that they were at in early December, given where there was such a high breadth, sharp, tremendous move down over the course of a series of 4 or 5 days that were real panic.
exactly. And just if you're curious, the last time that it was this low in terms of a percentage of S&P stocks hitting their 52-week high on a breakout to all-time highs, March 2000. So obviously, internet bubble time.
That was
But
the time when it turned, yes.
yeah, so just a curious thing to throw out. Not certainly not making a call, but let's get into the last two that I think are the most interesting. And one is a build off of what you were discussing last week, Brett, and that was data showing no one is particularly leveraged. So the idea being that once we saw leverage coming in, that this could add to the breakout potential. And we look at the risk appetite index, which rolled in onto this, showing a pickup in activity. This is more of a survey data, but you want to give us your thoughts on the read as we move towards excessive optimism on this reading?
Yeah, I mean, I think that there's a lot of credit spread play in here. So I think we're starting to see the spread between essentially the 10-year and junk bonds really narrow, and I think that's a big input here, and I think it's probably one of the main reasons we're not seeing a big. I mean, this is really coming from it adds together basically the Citigroup Macro Risk Index, the Westpac Risk Aversion Index, and the UBS G10 Carry Risk Index. So when you start to see a lot of different factors like credit spreads, foreign exchange volatility, gold prices, the difference between utility sector, for instance, and the financial sector, so things that are more defensive outperforming, you can see the degree to which people are taking on risk. If credit spreads are really blown out, in other words, people are tossing junk bonds overboard in favor of treasuries, they're buying lots of gold, they're not willing to go outside of healthcare stocks and utility stocks, then this tends to show an extreme of bearishness. It was at that type of situation in August. It was at that point. So we were doing those sorts of things, and that was one of the reasons why we had 10-day put call up above 1.14 was another similar indication. There was an odd level of panic in the market in August, and it formed an important low, and the market's ripping off of that low right now to break out. This is normalizing now because those factors are normalizing now. They're relative to where they were in August. They're all coming back into more typical levels that don't reflect an immediate and intense fear of the cycle unraveling. So I wouldn't look at this as this is a lot of market-based indicators. This isn't necessarily exuberance you're seeing. You're just seeing a relaxation, an unclenching of muscles, in a metaphoric sense for the market as people start to remove a lot of those big hedges. That is on the road toward complacency, which is on the road toward euphoria, which is on the road toward a problem for the market. But I don't think that we're anywhere near that destination at this point.
All right, and just as a quick heads up, we are paying attention to the markets here. We're seeing them break to afternoon session lows. For my money, I just think that this is simply some profit taking coming off ahead of, and we'll talk about it a little bit, and Brett and I will do a preview tomorrow, but on what's likely to be a hawkish rate cut.
Yes.
So that's my take on this action, Brett. I don't know if you got any thoughts here as we roll over towards afternoon session lows.
I completely agree. That's what I focused on in my morning notes, the idea that we could see the market blink a bit today because you are coming into what I think everybody's just starting to really look at what a hawkish cut this might be because there's just so many elements that line up to. I imagine the Fed at their meeting today, just a lot of the conversation is being, how did we corner ourselves into cutting rates
Yeah,
right now?
I love that comment that you had because I completely agree with that.
Yeah,
You know,
they are cornered. They got to do it now.
well, I'll
But
tell you what, if they got a picture of 45 over them, they'll know how they got cornered into it, I suppose.
yeah, that's certainly part of it.
Okay, and the final piece here, Brett, in the Sentiment Trader. Um, Everybody can follow along on this at 1423. Brett posted a SPY Liquidity Premium chart for us to reference. So please click on that now. And Brett, you want to run us through what you discussed in this chart? And I know you mentioned it a little bit ago, but a little bit more in depth on the SPY Liquidity Premium and why it's important.
Yeah, sure. So this is essentially, it is about where volume is going. Is it going into, and this is just, it's a sampling. This one uses the SPY ETF. There's a QQQ liquidity premium. You could do a futures liquidity premium. Anything where you've got an index instrument and it's got a bunch of components. So the SPY is the ETF that represents all of the 500 stocks of the S&P 500. And you can put if you want to buy stocks, you can buy the SPY, or you can buy shares in a bunch of individual stocks, right? And so the premium is the idea of, where is the volume going? Is it going into the SPY, or is it going into the individual stocks that make up the S&P 500? So this ratio that you see, the oscillating blue line, is essentially about the ratio between whether it's going to the SPY or it's going into the individual stocks. And there's been periods where the market becomes a function just of the SPY, and there's other times when there's no volume really in the SPY compared to what's going on in the individual stocks. And the red circles at the bottom represent periods when you were talking about the first 2 weeks of earnings season. And so I just wanted to point out that it's always way down during the first 2 weeks of earnings season. It doesn't matter what the market is doing, and that's because it's earnings season, because you've got a lot of different equity fund managers who are repositioning based on earnings, and so they're putting a lot of volume in and out of their various holdings. And it's the early period of earnings season that becomes the defining period of earnings season. It's a bit like sampling data on a poll during an election. When you get enough votes in a particular district, you know what the outcome is going to be. Even if you only have half of the votes in, you can basically call the winner, because at a certain point you've sampled enough of that system to know what that whole system is going to look like. And earnings season works a little bit like that. There can be individual company blow-ups and surprises during the latter half of earnings season, but you get a sense of how particularly large cap companies are performing that quarter, and you can start to make assumptions once you get to a particular sample size. And what I've found is about the first 2 weeks of earnings season or so is it, and you have an identity about that earnings season. And if you see the SPY liquidity premium during the first 2 weeks of earnings season, just dives. And that's what we've seen now. That's not necessarily a measure of complacency, but the green circles are something else. The green circles are periods over the last year and a half, where I have personally made the most money trading index futures. Equity index futures. Those are the periods where I've had my biggest months, my best periods. And I just wanted to point out that there is that correlation. And it's one of the reasons why I tend to not trade index futures very much during the first 2 weeks of earnings season, because you don't see identifiable, clear-cut setups in the equity index futures during the first 2 weeks of earnings season. The top-down instruments like the SPY or like the ES or the NQs or the YMs or a lot of the different things that you see me trade, they become a function of a scattering of bottom-up influences rather than a function of money flowing in and out of those particular instruments. And that really makes the patterns far less predictable, and the follow-through, the resolution of those patterns, far less predictable. You can have a lot lower conviction because the story is really going on underneath the surface in the individual stocks. And I just wanted to show this chart as a very visual and very clear representation of that. July was a great example. During the first 2 weeks of July, I traded almost none because you can see it's one of those red circles. Right after that, we got a lot of volatility, which helped too, but it's also a period where you start to see the market become dominated by the index instruments, where you want to move to a more top-down trading direction. So that's the main thing I wanted to highlight here. Two basic points. One, if you like to trade equity index futures, you really want to focus on periods outside of the first 2 weeks of earnings season to do most of your risk assumption, most of your trading play. But the other one is that this particular dive in the SPY liquidity premium is probably something that is not necessarily a reflection of extreme complacency. This indicator is supposed to show, complacency and fear, but one of the other tendencies that it has is to show simply when you're in the first 2 weeks of earnings season.
All right. That's a fantastic breakdown for us there, Brett. So, obviously, something that you're going to want to continue to watch for, and we'll circle back around next week in the Flow Show. We usually touch upon this one on a weekly basis. So, as you can see, it could fluctuate, and we'll keep an eye out on that. Two small pieces while we're talking here. Enphase, that stock was hit by a cautious comment from Liquid Capital at the Robinhood conference. Shares have slipped into the red there. They report, I think, after hours today. I'll have to double check that. And then Fitbit, seeing a little bit of a breakout as there's some chatter that Google could be interested in buying them. That's coming from Reuters. Okay. So, Brett, now it's time to move on to our latest new toy, and that would be the Barron's Fund Manager Survey. They do this twice a year, springtime and fall. So, you get some pretty good updates on some longer-term money investments and where people stand. And I think one of the things that just jumped off the page, and it really kind of fits into what we've been looking at, Brett, is that only 27% of money managers that responded to Barron's 2019 Big Money Poll call themselves bullish about the market prospects for the next 12 months. Mm-hmm. This was down from 49% in its spring survey, 56% a year ago at this time, and was the lowest percentage of bulls in more than 20 years.
Which takes us to when?
Which takes us to the internet
about
bubble,
98,
of course.
Right, right. What happened after this data point 20 years ago?
We ripped higher. And, this is what we've been talking about, just the positioning for people and the sentiment on top of it. Yet the price action just simply does not play out into what you're reading and what you're seeing. And, I don't think anything is really hammered home that idea more than this particular data read here, Brett.
No, it's extraordinary. I mean, it's a perfect kind of capping summarization of what we've been talking about, that there's this pervasive skepticism that has maintained itself. And if we start to see, particularly what we talked about with the sort of upstream supply chain manager having to play scramble on a pent-up kind of situation where, demand maintains itself, but those inventories have been drawn way back, somewhere along the supply chain, somewhere along the manufacturing process, you have to start, really jumping to it and really making up for lost time. See dynamics like that. If we get if we see the White House kind of move with the narrative that we talked about last week as well, where they're really kind of trying to juice some of those, economic confidence indicators by really framing the trade war and any other issue they can in a really as positive a light as they possibly can. The market's breaking out to new all-time highs. People are trailing their benchmarks. It all adds up to a situation where it's not impossible that we could trigger that scramble from some of these guys who have been very clearly, and this poll is just another example, more on the sidelines than would typically be the case. And, that demands a kind of chasing response at a certain point, which is the same type of thing that no doubt we saw in 1999 and 2000, earliest part.
Right, and that's just the last time it was this low, Brett. I mean, we look at some of the other times. 2016, obviously, both the spring and fall were below 50%. And we obviously had that big rip. Not a surprise to see this, though, during the election year, right? Wouldn't you agree?
Especially this one.
Especially this one, yeah.
But impeachments and everything else going on, this is it's difficult to be, particularly sanguine about the economic prospects, but that doesn't mean that that's necessarily going to be the correct position.
Right. And then we also had the spring of 2015 was low. Fall of 2012, that would have been around Grexit, right? Around the euro.
Market launched off of that, yeah.
Launched off of it. Spring of 2010. Of course. the one time they did get it right would have been 2007, the spring and
Yeah,
fall
exactly.
there.
Which is
But I mean, if you think about it, the spring of 2007, we still saw all-time highs later on that year, right?
absolutely we did. Yeah.
Then 2005 as well, 2002, which would have been the end of that internet crash bubble, and then of course 99, which is the last time we saw it this low. So
Well, and the data set that I had didn't go back further than that, but the poll exists back further than that. So
yeah,
you
exactly.
can,
That's just all the
right,
data we could find. So
right,
the bottom line is when you see him this bullish, like Brett said, um,
bearish.
or bearish, I should say, the bubbling up of sentiment is certainly potentially there. So taking a look at some of the other findings from this, Brett, let's take a quick look.
Sure.
Based upon the mean prediction, they expect the S&P 500 index to fall about 2%, while the NASDAQ will relinquish about 5%. So obviously a little bit more cautious there on the technicals.
Yeah, I mean, who knows? That's an aggregate attempt to discern a number, which is probably made of a lot of different inputs. But yeah, I also thought it was interesting that, while the level of bulls was the lowest, the level of bears was also the highest. So it's not just people aren't sure what the market is going to do. It's also the greatest number of people who think that the market will go down.
Right. I thought this was kind of funny. And again, this is just a survey. We're not a political website. We're not trying to get political here, but I just found it an interesting read. So, two-thirds of the poll respondents gave the president a grade of C or worse in the fall survey. A year ago, half of the money managers believed that Trump deserved a grade A or B. So, obviously, a decline there. But this is the kind of the funny thing about it. Nonetheless, the president is the preferred candidate of 42% of big money managers in the 2020 presidential election, with runner-up Joe Biden, the next pick at 25%. 62% of big money investors expect Trump to win re-election next year. So,
And and 99% believe the market would react negatively if Elizabeth Warren were to win.
yeah, 99%. Because 61% prefer Biden over Warren, and 64% see Warren emerging as the Democratic
Yeah.
primary as the party's
Well,
nominee.
I mean, the one other thing that I think, since it's 99%, you understand that this has implications. This is a survey of large money managers. Um, that really does tell you that those who are bullish and who are highly positioned, if one of the scenarios that I painted in my notes a couple days ago was the idea that if we see this impeachment process head into the Senate's going to be in a position where, it's GOP controlled. They're going to be in a position where, the way that process, that hearing is framed is going to be a little different than we're seeing it in the House, certainly. And the idea that Joe Biden will be drawn further into it is probably, relatively likely. And that means that if it has its worst moments will be bad for both Donald Trump and Joe Biden, and therefore, by default, really good for Elizabeth Warren. So I think that we can look forward to a period where, there's plenty of breaking headlines that, given this data point, 99%, 99%, where we could see a very sharp knee-jerk reactions to the downside as the twists and turns of the Senate version of this impeachment process start to take shape, and as particularly there are moments where there are revelations that are difficult to digest and have negative implications for both Donald Trump and Joe Biden, you could see the market's reaction will be to price in, further discount the possibility of a Warren presidency. And if 99% of large money managers have this feeling about it, then you can imagine what their reaction will be.
All right. Yeah, I mean, those polls are definitely going to be I don't know if I want to say trader's nightmare or dream, but it'll definitely be creating a lot of volatility based around these numbers and how dynamic the divergent, I should say, the differences are. So about a third saw a U.S. recession arriving in 2020, while two-thirds don't expect the economy to contract until 2021. That makes sense given their expectations for Trump to win a second term, right?
Say that again. Sorry.
They said that a third see a recession in 2020, while two-thirds don't expect the economy to contract until 2021. And I said that probably makes a lot of sense given their expectations for Trump to win re-election.
Yeah, I agree. Right. If you flip those stats, then I'm certain that they would feel a little different about who the likely winner was.
All right, they would seem to be pretty equally divided over Trump's tariff policy and whether or not the trade conflict might end. 40% see a resolution before the 2020 elections, while another 40% see the trade war continuing for years. I'd be curious. I mean, I think that's a pretty open-ended uh, comment about seeing a resolution in 2020. Would you not agree?
Yeah,
So, and then big money investors cited healthcare stocks as the most vulnerable to election risk, with
certainly.
53% of respondents concerned about the potential impact no matter which candidate wins in November 2020. So, again, that's an
Yes,
important
because they're
number
both
there.
both sides are potentially going to be populist.
Yeah,
Yeah, and
exactly.
that's not a great environment for insurance providers.
Correct. So, anyway, so, all right, Brett. Before we get into the final thing, we're going to just kind of touch upon the basket or a basket of plays that we've been talking about with that inflation theme. Before we jump into that, Brett, is there anything that we missed on the Barron survey or sentiment data that you wanted to touch upon?
No, I think we've nailed into place the broad strokes pretty well here.
Right. Somebody just remarking, remember how negative the market was about Trump prior to his elections and initial response. And certainly agree, and that's kind of why we're pointing out that 2016 data prior. So that is not lost upon us here. And so, all right, Brett. One of the things that we discussed about, one of the themes that we saw the least position for was an inflation theme. We are going to put together a basket for people in the coming weeks. But right now, I mean, basically, it's just some of the basics that we'd be looking at here in terms of basic material stocks. Dry shippers will be another area that we'll be looking at. Emerging market stocks, copper, silver, inverse government bonds, of course, tips as well. So that's going to be what we're looking at for the basic basket. I think gold is probably one we could add in here too, Brett. But what I'm curious to see is that PCE number out on
Yes.
Thursday morning. I think that looms pretty large. Obviously, commentary from the Fed around inflation. That's going to be one of the more interesting aspects for tomorrow's statement as well. So, what are some of the things that you'll be looking at in the coming sessions for that inflation number? And if there's any asset classes that I failed to announce in terms of what's going to be our basic portfolio setup here.
No, I mean you're exactly right. I think the PCE is one of the most interesting data points to come. Given we saw core CPI move up to 2.4% at the last read, PCE has been divergent. If it continues to be divergent, that's important. But if it's starting to pin together a little better, then it really does change, I think, how people perceive this environment completely. So I think that that's going to be, obviously we're going to hear the Fed, we're going to hear the sentiment around it, we're going to get a sense of where Powell's at. I think that, as we talked about earlier, I think it's going to be a process of, okay, here's this cut, but don't expect any more. And, this easing cycle is over, and we'll see how the market responds to it. I guess the most important piece of information will be how the market responds to hearing that kind of rhetoric.
Right. Okay. One quick cleanup question here. Somebody is asking about the sector briefings. Is there an easy way to search for that? The ETFs, I believe, are how Pat O'Hare and his team are posting these. So, for instance, the energy one would be under XLE. I will ask them for an update on that because it is a nice piece that they put together here. Just doing one quick test. Yeah, so I think it's basically being posted under the the sector ETF. So the energy one that went up just shortly ago was under the XLE. So we'll get you an update on that, but definitely keep an eye out for those comments. So, Brett, I think that does it for us for now. We'll be bouncing back together again tomorrow ahead of the Fed, probably around 11:30. I think we're going to do a quick short one to get everybody prepped on what to look for. But is there anything that we failed to mention that you wanted to pull out here before we close this segment?
No, no, that's good. We'll talk tomorrow.
All right, you want to do any sort of closing summary, as you always do a great job at tying this all together?
Short one. So, yeah, I mean, the theme that we've been discussing would appear to be unfolding to some extent at this point, given that we have a general improvement in overall what you might call general conditions after seeing a period of tremendous skepticism. One warning sign would be, so in my last chart book, I posted a couple of charts of the 3-month to 10-year spread, the yield curve spread. And it had inverted famously back in April and stuck down there for a while and recently came out of that inversion. It's not impossible that all outcomes are in play here, and not just one or the other, but all of them, in fact, happening together. One, we get an improvement in economic conditions. We get a major and extended breakout over the next several months in the S&P, and then we get a major reversal, and then we get a move into recession next year. That is something that everything points to at the same time as being maybe the likely base case flow of things. It doesn't have to happen that way, but you see historically, when you get a deep inversion of the 3-month to 10-year, you get an uninversion, and then several months later, you move into recession. It's happened essentially every time. And that would be consistent with the idea that we would be moving into recession sometime midway through next year. Typically, that sort of thing happens before the final blow-off, and this would another one of the points that I made in that chart book is if you look at the divergence between the Russell 2000 and the S&P, we saw the same type of divergence in early 1999. They diverged a lot right now. You see a blow-off move in the Russell as it plays catch-up. It's a short-lived one. The market then reverses and heads back down. The larger time frame pattern on the S&P, if you look at a weekly chart, could be seen as a big, what's called an ending diagonal triangle, a big wedge topping pattern. Wedge topping patterns generally have first a blow off to the upside through the top line of the pattern, and then a move all the way back down through the bottom line of the pattern. This could all kind of play out all together. The sentiment data, the way we see it now, would fit into that view the same way. People are really skeptical now, but they're forced to chase into year end. But it turns out that their long-term basis for that skepticism is actually well placed, and then they get flooded back out of those positions. So there's a lot of different indicators that all add up to a kind of base case view, and this is why I titled the macro chart book Euphoric Head Fake, is this idea that we see a big blow off to the upside that isn't necessarily sustainable. It kind of sucks in the remaining potential buyers who've sidelined themselves and who end up chasing, getting caught up in it, and then getting spit back out because the underlying environment isn't necessarily improving, and this could even be fomented by this kind of pent-up catch-up move in some of these upstream supply chain managers who've basically understocked. But that doesn't mean that that's going to create a situation where the cycle can necessarily move on for years from here. So we'll see how this all works out. But I think that the one thing that you can depend on right now is that this really doesn't have any of the hallmarks of the type of breakout that you want to be aggressively fading, simply because there's not any of that exuberance and speculation that's really in the process right now. So that's how I would tie it together.
All right. Great job as per usual, Brett. All right, well, we will be posting this shortly. Again, Brett and I will be back on tomorrow to give a little bit of a preview of the Fed, and we certainly will be paying a lot of attention to some of the bigger macro data coming out towards the end of the week. Still a lot of earnings, of course, to come out. And then, this should all set us up for a pretty good chat next week as we turn into November and get prepared for that big Chilean meeting between President Xi and President Trump. So, Brett, you take care of yourself, and we'll talk to you shortly.
Okay, you too, Gav. Thanks.